4 years ago, Tishman, Speyer Properties and BlackRock Realty paid close to $5.5 billion for Stuyvesant Town-Peter Cooper Village, the largest apartment complex in New York City. Now, 2 weeks ago, they missed a $16 million debt payment, and now, faced with the possibility of foreclosure, they've decided to cede control of the complex. Well, how will this resonate in the world of distressed debt? We have some experts with us. Langford is the head of distressed debt at Deloitte Touche. Also joining us is David Ying, Senior Managing Director of Evercore Partners Corporate Advisory Business, also the co-head of the firm's restructuring practice. In the past year, Evercore has advised CIT, GM, and LyondellBasell, among others. Gentlemen, welcome. Good to have you with us. David, Guy.
Good to be here.
You know, this whole idea when we talked about Peter Cooper Village and Stuyvesant Town, I mean, the thing to note really is there was not a lot of equity involved in this when they made the deal, right? I mean, we talk about a $5.5 billion price tag, but they didn't put in a lot of cash to make this deal happen. Is that an example of how times have changed, that in order to make a deal happen now, you got to have a lot of equity involved? Guy?
I think times have certainly changed, Pimm. And this is one of probably a couple of examples that we have seen and will see over the course of the next 12 to 18 months. Real estate owned, going back to the lenders or the banks. Lending markets have changed, obviously, since those deals were originated. And I think we will see a number of examples, actually, where the owners and the equity providers behind the deals say to themselves, you're going to know when to hold it, you're going to know when to fold it. And in this instance, and there will be other examples as well, where that will continue to happen.
David, come in on this topic. I mean, is this going to be sort of a marker when we look back at the history of distressed debt and real estate and say, you know what, you're really going to have a lot more equity in the game to play?
Well, commercial real estate has been a unique marketplace, and commercial real estate has been heavily dominated by the securitization market, which is this process whereby you package securities, you tranche them into various layers from senior to subordinated, and then you place them broadly into the capital markets. That market, like many debt markets during 2006 and 2007, benefited from the growth of leverage in all of the debt capital markets. I think in the case of commercial real estate, people were able to construct very leveraged credits without a lot of equity. When you look at the corporate markets, that phenomenon may have existed back in the late 1980s when the first big LBO boom started, but more recently, as people realized that poorly capitalized companies were very dangerous, that has not happened in the corporate market. That hasn't prohibited the corporate market from experiencing distress when the economy turns down. But I think the commercial real estate market is going through some growing pains, and obviously it's causing a lot of dislocation today.
All right, Guy, now taking that as sort of a lead off, I mean, there is money available for deals, right? I mean, because whether it's equity going into a deal, there is equity potentially available because so many companies have raised money, right?
Yeah, Pimm, there are huge sources of equity out there right now. We call them war chests or pools of capital. You've got a lot of private equity funds sitting on the sidelines, approximately $90 billion just designated to commercial real estate in the U.S. You've got a pool of public vehicles in the U.S. that are tapping into the public markets, whether it's a new offering or a secondary offering. I think it was $30 billion for 2009. You've got sovereign wealth funds who are out there with large war chests, and you've got other offshore sources. So plenty of capital on the sidelines